Two people sit in the same city, same job title, same gross salary, $71,000 a year. One of them writes a check to the IRS every April. The other gets a refund and immediately reinvests it. Same income, different outcomes. The difference is not a loophole. It is not a trick. It is not something a financial influencer found in a comment section. It is control. Control over timing, control over deductions, control over how income is categorized before the government sees it. That is what this ladder is about. Not evasion, infrastructure. Level 1, the W-2 employee. You receive a paycheck. Before you see it, the money has already moved. Federal income tax withheld, state income tax withheld, Social Security, Medicare. Your employer calculated those numbers based on a form you filled out when you were hired, possibly in a rush, possibly without reading it, possibly on your first day when you were also learning where the bathroom was. That form is called a W-4. Most people fill it out once and never think about it again. That is the first place where control either begins or doesn't. The withholding system is not designed to optimize your taxes. It is designed to collect them reliably. Those are not the same thing. If your withholding is too high, you are giving the government an interest-free loan all year and celebrating in April when they return your own money. If it is too low, you owe a balance due and possibly a penalty. Most people discover one of these two things every spring and treat it as weather. It is not weather. It is a calibration you can adjust. At level 1, the primary tax tool is the standard deduction. In 2024, that number is $14,600 for a single filer. What this means mechanically is that the first $14,600 of your income, after arriving at adjusted gross income, is simply not taxed. You do not have to prove it. You do not have to document it. It exists as a floor. Most W-2 employees take it automatically and move on. That is usually correct. But understanding why it exists changes how you think about the decisions layered on top of it. Above the standard deduction, the tools available at level 1 are narrower than most people assume. A 401k through your employer, an IRA. That is largely the list, but the cost of not using them is not abstract. If you earn $71,000 and contribute nothing to a traditional 401k, your taxable income is $71,000. If you contribute $7,000, your taxable income is $64,000. At a 22% marginal rate, that is $1,540 you did not send to the federal government this year. You sent it to your future self instead. The mechanism is simple. The daily decision to do it or not is where most people stall. Common mistakes at level 1 are not dramatic. They are quiet. Under withholding after a second job is added mid-year. Forgetting to adjust the W-4 after a raise moves income into a higher bracket. Cashing out a 401k from a previous employer when changing jobs because the balance was small and the paperwork was confusing. That last one creates a taxable distribution, a 10% penalty if you are under 59.5, and a surprise bill in April that feels like punishment for a decision that took 4 minutes. It is not punishment. It is a consequence of not understanding the mechanism before pulling the lever. Level 2, the high income professional. Something changes around $90,000 to $120,000. The standard deduction becomes a ceiling instead of a floor. At this level, the question is no longer whether to take the standard deduction, but whether you have enough qualifying expenses to exceed it. Mortgage interest, state and local taxes up to the $10,000 cap, significant charitable contributions. If those numbers added together beat $14,600, itemizing saves you money. If they don't, it doesn't. The math is not complicated. The discipline of tracking it throughout the year is where most people fall short. At level 2, the 401k limit is $23,000 annually. The HSA, if you have a qualifying high deductible health plan, adds another $4,150 for $1,150 for a single filer or $8,300 for a family. These two accounts together can remove $27,000 to $31,000 from your account. $1,000 to $31,000 from your taxable income before you touch anything else. That is not a small number. On a $120,000 salary at a 24% marginal rate, fully loading both accounts saves approximately $6,500 to $7,400 in federal income tax in a single year. The HSA has an additional feature that most people miss. The money invested inside it grows tax-free and comes out tax-free for qualified medical expenses. It is the only account in the tax code with 3 layers of tax protection. Most people use it as a debit card for copays. That is a valid choice. It is also a choice that costs them a compounding asset. The backdoor Roth appears at this level for a specific reason. Once income exceed certain thresholds, direct Roth YRA contributions phase out. The backdoor is a two-step mechanism. You contribute to a non-deductible traditional IRA and then convert it to a Roth. It is not a workaround. It is a documented and legal process that the IRS has issued guidance on. The cost is administrative attention. The benefit is decades of tax-free growth on money that would otherwise be taxed on the way out. Equity compensation arrives here too, and it arrives with a clock attached that most people do not notice until it has already run. RSUs vest and become ordinary income on the vesting date whether you sell them or not. Options have exercise windows that expire. Incentive stock options carry alternative minimum tax exposure that does not appear in any simple calculator. The common error is treating equity like a bonus that shows up fully formed in your account. It does not work that way. The tax event and the cash event are often separated, sometimes by months, sometimes by years, and the gap between them is exactly where unexpected bills are born. The real upgrade between level 1 and level 2 is not the tools. The tools are available to anyone who earns enough to use them. The upgrade is the shift from compliance to planning. Compliance means filing accurately. Planning means making decisions in October that change what the return looks like in April. It means choosing between a traditional and Roth 401k based on projected income, not habit. It means reviewing your W-4 after any life change, not just when HR sends a reminder. It means knowing whether you live in a state that taxes retirement distributions before you decide which account to draw from first. What this costs is real. Good tax software runs $80 to $150 per year. A CPA who specializes in this range of income charges $300 to $800 for a return with equity comp and itemized deductions. A fee-only financial planner charges $2,000 to $4,000, $500 annually, and does not earn a commission on anything they recommend. These are not luxuries at level 2. They are the cost of not leaving $6,000 to $12,000 on the table every single year. What can go wrong is also real. Lifestyle creep absorbs every raise before the contribution rate increases. RSUs are spent as income without reserving the tax. A move from a no income tax state to a high tax state mid-year creates a filing obligation in 2 states that nobody planned for. The 401k is maxed while credit card debt accumulates at 22% interest in a different column of the same spreadsheet that is supposed to represent a financial plan. Control is not a mindset. It is a set of decisions made at specific moments using specific mechanisms. The people who build wealth from a W-2 are not smarter than the people who don't. They made different choices at the moments when the choices were available. That is the infrastructure this entire ladder is built on. At some point, the W-2 is no longer the whole story. A freelance project turns into a second income stream. The second stream turns into a client list. The client list turns into something that has a name and a bank account and eventually a quarterly tax obligation that nobody warned you about until the penalty notice arrived. This is level 3. The side hustle that became a business. The new problem is not revenue. Revenue is the good part. The new problem is that self-employment income arrives without withholding, which means the government was not collecting throughout the year, which means the bill is waiting for you in one place at one time unless you built the system to intercept it. The other new problem is self-employment tax. On a W-2, your employer pays half of Social Security and Medicare. When you work for yourself, you pay both halves. That is 15.3% on net self-employment income before federal income tax begins. Most first-year freelancers discover this in April. The ones who survive it without derailing their finances were the ones who understood the mechanism before they needed to. The tools at level 3 are bookkeeping, deductions, quarterly estimated payments, and the question of entity structure. They sound administrative because they are. That is exactly the point. The job of these tools is to turn a chaotic flow of uneven deposits into a set of records that are boring, consistent, and defensible. Not clever, not optimized to the edge. Boring. The IRS does not audit boring. They audit patterns that don't hold together under a second look. Bookkeeping means that every dollar in and every dollar out moves through a separate business account and gets categorized, not at year end, monthly. The reason is not aesthetic. The reason is that the legitimate deductions available to a business owner, home office, vehicle mileage, equipment, professional development, software, only hold up when they are documented at the time they occurred. A receipt reconstructed from memory 11 months later is not a deduction. It is a story. The transition from Schedule C to an S corporation is not automatic and not always correct, but it solves a specific problem at a specific income level. When net business profit reaches a range where the self-employment tax savings from paying yourself a reasonable salary and taking the remainder as a distribution exceeds the cost of running payroll and filing a separate return, the math shifts. That threshold is roughly $40,000 to $60,000 in net profit for most businesses, and the answer depends on your state and your specific numbers. The mechanism is not magic. It is a structural decision that changes how income is categorized before it reaches the tax return. What the tools actually do collectively is separate your personal financial life from your business financial life with a wall that holds under scrutiny. Commingled funds, personal expenses run through the business account, a deduction for a dinner that was not actually a business dinner. These are not aggressive strategies. They are audit triggers and record-keeping failures that collapse under documentation requests. The goal of this infrastructure is not to maximize the deduction. The goal is to capture every legitimate deduction and leave no footprint that invites a second question. Daily decisions change at level 3 in a way that is difficult to describe until you are living it. Every purchase becomes a documentation event. The mileage to a client meeting is a business record. The software subscription is a line item. A lunch that crosses into genuine business discussion requires a note about who was there and why. This is not burdensome if you build the habit early. It is genuinely burdensome if you try to reconstruct it later. The calendar matters now in ways it never did on a W-2. Cash reserves matter because quarterly estimated payments come due in April, June, September, and January. And if the revenue month before payment was light, the cash still has to be there. Level 4 is where the machinery becomes more complex, and the tax decisions have longer time horizons. Real estate at this level introduces depreciation, which is a timing tool. The IRS allows you to deduct the cost of a building over a defined number of years, recognizing that structures wear out. This deduction reduces taxable income on paper even when the property is generating positive cash flow in your account. It is not free money. It is deferred money. The depreciation you took is recaptured as income when you sell, and that recapture is taxed at its own rate. Understanding that the bill is deferred, not eliminated, is the most important thing to understand about this tool. Cost segregation is the process of accelerating that depreciation by reclassifying certain components of a property as shorter-lived assets. It produces larger deductions sooner. It is legitimate when done by a qualified professional with actual engineering analysis. It is also expensive to do correctly and produces a larger deferred liability that must eventually be addressed. The 1031 exchange is a deferral mechanism that allows you to sell a property and roll the proceeds into a like-kind property without recognizing the gain at the time of sale. The gain does not disappear. It rides forward into the new property's basis. The eventual bill moves with it. Passive activity rules exist specifically to limit how much real estate loss can offset ordinary income, and the limits depend on how active your involvement is and how high your income is. Misunderstanding these rules is one of the more common and expensive mistakes at this level. What it costs to operate at levels 3 and 4 is real and ongoing. Accounting fees, payroll processing if you run an S-corp, better banking infrastructure, more sophisticated credit facilities, higher scrutiny from lenders who want to see 2 years of business returns before approving anything. Liquidity constraints from reinvesting into assets that are not easily converted back to cash. What can go wrong is also real. Aggressive deductions taken without documentation, mixed funds that obscure the line between personal and business, missing quarterly estimates until penalties accumulate quietly. Over-leveraging into real estate because the depreciation made the numbers look better than the cash flow actually supported. And the most underestimated mistake of all, deferring taxes across multiple tools and multiple years without a clear plan for when and how the deferred bill gets paid. Deferral is a strategy. Forgetting about deferred taxes is not. They are not the same thing, and the distance between them is exactly where financial plans fail at the moment they were supposed to succeed. Level 5 is where the business stopped being a business and became a company. There is a distinction. A business is something you run. A company is something you own. The tax problem at level 5 is not self-employment tax anymore. The tax problem is that you have built something worth real money, and the IRS has an opinion about every way you might try to access that value. Compensation design becomes a legal and structural question. How much do you pay yourself in salary versus distributions, and how does that split interact with payroll taxes, retirement plan contribution limits, and the characterization of your income across the return? There is no universal answer. There is only a defensible one that was designed by people who understood the specific business, the specific income level, and the specific exit horizon. Retirement plan leverage at this level moves beyond the Roth and the 401k. A defined benefit plan, if the business can support it, allows contributions that are many multiples of what a standard 401k allows. The mechanism is that you are pre-funding a pension for yourself based on actuarial calculations. The contribution is a business deduction. The money compounds inside the plan. The eventual withdrawals are taxable, but the timing and the magnitude of the deferral for a high-income business owner in the right decade can be structurally significant, legitimate, documented, expensive to set up correctly, not a shortcut, a tool with a specific job. Risk containment at level 5 means the company that holds liability is not the same entity that holds the valuable assets. Operating in a single entity where the business operations, the intellectual property, the real estate, and the cash reserves all sit in the same legal container is a concentration problem that one lawsuit can resolve badly. The structure is not complicated to describe. It is complicated to maintain correctly over time. Exit planning begins the moment the company has value, not the moment someone offers to buy it. The qualified small business stock exclusion applies to gains from the sale of certain C corporation stock held for more than 5 years, and the exclusion on that gain can be substantial. The structure has to be in place before the gain exists. Retrofitting the structure after a letter of intent arrives does not work. This is one of the more expensive lessons in this space, and it is a lesson that is almost always learned by someone else while you watch. Level 6 is a shift from earning income to controlling capital. The assets are large enough now that the question is no longer how to build them. The question is how to hold them, transfer them, and deploy them across time and across people without the structure working against the intention. A family LLC or family limited partnership allows assets to be held inside an entity where interest can be gifted at a discount because a minority interest in a private entity is worth less than its proportional share of the underlying assets. The IRS is aware of this. The discounts must be supportable and the entity must have genuine economic substance. A family LLC that exists only on paper and functions as a personal checking account is not a family LLC. It is a problem. Trusts at level 6 are not estate planning products. They are governance documents. An irrevocable trust removes assets from your taxable estate and places them under a framework that specifies what can be done with them, by whom, and under what conditions. The assets inside the trust can be invested. They can be distributed to beneficiaries. They can be managed by a trustee who is not you. What they cannot do, if the structure is legitimate, is come back to you in a way that triggers estate inclusion. This is the mechanism, not magic, not avoidance. A formal decision made in writing that has legal consequences. Donor advised funds allow you to take a tax deduction in the year you fund the account and distribute the money to charitable causes over time. You do not have to decide the recipient at the time of the contribution. The investment inside the fund can compound tax-free until distribution. For a business owner who has a liquidity event in a single high-income year, the timing of a donor-advised fund contribution into that year is a straightforward planning decision. Level 7 is not a tax strategy. Level 7 is an institution that a family is running. Dynasty trusts, estate-free structures, charitable foundations, family governance documents that specify voting rights and distribution policies and conflict resolution protocols. These are not tools that individuals use. They are systems that families maintain. The compliance cost is real. Legal teams, accounting firms, administrators, annual filings. The IRS scrutiny at this level is different in kind, not just in degree. Structures that would pass without comment at lower asset levels are examined closely when the numbers are large enough to matter to the audit division that exists specifically for this purpose. Here is what all of these tools actually do. Across every level, they concentrate decision rights, they manage the timing and the transfer of wealth, they reduce friction between what you intend and what the law would do by default if you did nothing. They formalize who can do what with the money so that the answer does not depend on who is in the room that day. Here is what can go wrong. Control held too tightly produces dependence in the generation that receives the wealth and resentment in the generation that expected autonomy. Structures optimized past the point of clarity become opaque to the families they were meant to protect. Secrecy maintained long enough becomes its own governance problem. A trust designed around the values of the person who funded it will outlive that person. Whether the structure outlives the values is a different question, and nobody answers it at the closing. Pick the level you're actually in. not the one that sounds most interesting. The one that describes your current tax problem, your current entity structure, your current gap between what you earn and what you keep. Build the next piece of infrastructure. Records if you have nothing. An entity if the records are there. Investing discipline if the entity is running. A governance layer when the assets require one. Comment with the level you are in and the specific tool you want to understand next. That is the only way this ladder gets built.